Welcome, everyone, to the Quarterly Investment Advisory Board. I'm Steve Ankerstar, CEO of Ankerstar Wealth, and we've changed the design of this slightly from the fact of just me presenting before is now it's going to be more like set up like a conference call for stocks after they have their quarterly earnings, where the CEO presents, it initially gives an overview and then hands it off to the chief investment officer for most of the presentation. Then at the end, when the formal presentation wraps up, we'll open it up to question and answers. We shall see, we're going to use the chat tonight. So you see the bottom right, use the chat window. So pull that up if you can. If you can't pull up the chat window, maybe you're on a tablet or phone or something, just text me your question directly. And that way I will add it to the window at the end. So with that, I'm very excited for the presentation, and I'd like to introduce Mike YOUNKMAN, our Chief Investment Officer, for his first investment advisory board meeting, and it's also his birthday. So welcome, Mike, and over to you.
Awesome. Great. Well, thank you for kicking this off. And this is a great way to spend my birthday, is talking to all of you on this call, as well as whoever listens to this later on. So I wanted to start off by just saying to all of you, we at Ankerstar Wealth value your time. We value your time hopping on this call and listening, or listening into it later on. And we also value your time learning about investing, being part of our partnership. But here's the thing: wealth, your dollars, is essentially your stored time. So these dollars that we're managing is very valuable, and it's your stored time that you're building up for the future, whether that's for your comfort, retirement, or pass on to heirs. So I just wanted to start off by saying that. Go to our next slide. So our standard agreement that this is a financial education presentation, so you must do your own due diligence before acting upon anything you hear about our investments or projections for the future. Further disclaimers can be found at Ankerstar Wealth. All right, and you can see our team here listed out, and kind of concentrating on the right side. What do? We want to make as much money to invest your time to bring that, your retirement, to bring your dreams to fruition within your risk tolerance and capacity. Certainly, our team is rapid response to customers. We want to coach, talk you through the volatile times. I've had friends talk to me saying the hardest decision is not when the market's going up. That's easy. It's when the market's going down. And that's what we certainly are there for you for those volatile times, and provide that long-term financial planning. Next slide. So overall, we're going to cover today where we've been, kind of what happened this last quarter, where we are right now, and where we're going in the future. So as far as where we are, this past quarter was an excellent quarter. S&P was up 10%, which is great news. Market seemed to be very positive, expecting rate cuts, and everything seems very good coming into this presidential election year. Overall, Ankerstar Wealth up to almost $82 million in market value. Continued relationships building. We're going to get your standard inflows of dollars as well as outflows for retirement planning, estate, things like that. Next slide. As far as an overview of the Ankerstar Wealth book, 83% of the 82 million is assets under management, another almost 11% assets under advisement, and a few other things that are out there. Overall, the company, we're focused on stocks and ETFs. There are some mutual funds that we utilize, and certainly direct bonds and CDs as necessary. And then there's alternative investments as well. Next slide. So this is an interesting slide to spend some time on, and we're gonna look at this for a few minutes. And this shows the top 10 assets by market value owned by Ankerstar Wealth. If you looked at this slide 3 months ago, you'll notice that there is a brand new investment in the number 2 spot that is Bitcoin, which everybody loves to talk about. You may have seen this under MSTR, but even since then, Bitcoin has done very well this first quarter. When you look at this asset list of these 10, you really see the breadth of what we're investing in. You see, high tech growth in Apple or, Amazon or Google, but then you also see high yields bonds in HYLS. You also see even risk-free investment in USFR treasuries. So you really see the variety that we're in, and even a JEPI, which is an enhanced income product. And I'll say a JEPI is very interesting because it's puts off a 7+% dividend yield and was actually up 10% since November. So, very well. So your portfolio will include some of these, but not necessarily all of them. Overall, when you look at the market, you'll say what I'll call the Fab Five. A lot of people hear it as the Mag 7, has done extremely well. We saw Apple and Tesla fall off this first quarter, so that's why I lowered it down to the Fab Five. You'll see me reference that later. But the expectation is the broader market is starting to rally, which is a good thing because we don't want just 5 or 7 stocks driving everything. Overall, I'm just prepping you that allocations are very likely to shift. So the next time, 3 months from now, when you look at this again, I'm sure you're going to see some new holdings on there, and you're going to see some of these holdings drop off. Things like BSV, which is a short-term bond fund, as interest rates change, the holdings in positions like that will change as well. Furthermore, we have election year clarity coming. So whether the market reacts to who becomes president, as we know more information, this will be better for the market. And then the last thing I just put in there, Bitcoin agility. And what that means is as Bitcoin grows, and we expect it will, we'll have to make decisions on when it's time to trim that at some point. Next slide. Or actually, before you go there, so as you look at this, before we go to the next slide. So I want you to picture this. When it comes to investing, we would love to think of it like surfing. And it's a beautiful weather outside, sunny, there's waves rolling in, we all go to the beach, and it's as easy as we just hop on a surfboard and go out and enjoy it. However, coming into this year or in 2024, I expect it to look a little bit different than that. When the weather's great and everybody can surf and it's as easy as picking any stock, people feel really good. Like, hey, I'm having great success picking my own positions. And we talk to those people every day. And when things are good, we all win. So we like that. We definitely like that. However, when people first start investing, or maybe they're newer to investing, maybe a few years in, maybe they've been putting money in their 401k, and now they're like, oh, I want to start really understanding investing. Go to the next slide. This is kind of what it looks like. You get a lot of people crowding around the same places. And some people are trying to stand up. Some people are, throwing money into positions where, like, hey, I heard NVIDIA is doing really, really good. I want a piece of that. I heard this is doing really, really good. And they all crowd in, and they're not quite sure what to do. And they just see how it goes. And you end up possibly investing at the high side. You also have people that are going against the current. You can see the surfer going against that way. But what happens in a year like this year, we expect it's going to be a little more difficult. It starts to look like this next slide. The weather gets rough, and you start to see the Fed, who is, I'm going to call it our lifeguard, say, they're giving us warnings. There's rough waters ahead. We're dealing with inflation. We're dealing with unemployment. We're dealing with an inverted yield curve. They're looking at all these things, and they're kind of giving everybody a heads up. It's not going to be as easy as it has been in the past. And even as of just even a few minutes ago on the Wall Street Journal.com, Chairman Powell, hey, unemployment wages are down, and people are like, well, not unemployment, wages are down. So possibly we can lower rates. I mean, it's always this consideration. So what I want to do is show our next slide, and Steve has addressed this many times, which is our investment themes going into this year. Now, the reason why this is color coded is some of these themes haven't looked great in 2023. So the ones that are red and yellow, even though these are themes to invest on, they haven't necessarily done great so far. So, take an example, clean energy. Clean energy does really well when the interest rates are low because these are a lot of newer companies. Interest rates have not been low. So therefore, there's been a lot of struggle there. Healthcare, another one. Healthcare, we all need it, but the insurers are getting caught in the middle between government reimbursement and inflation. So they're seeing that. Emerging markets, and I put this India, largest population, but it's still considered an emerging market. We're going to have political discussions regarding tariffs, things like that. There's opportunities to invest here, but we got to pick the right time. Big banks and refinancing. Guess what? Right now, nobody's refinancing, or very, very few, because interest rates are so high. But later on, that's a good opportunity to get involved in. And then that last yellow one I really want to call out is during 2023, to look at the S&P growth beyond the Mag 7 was not pretty. The Mag 7 drove everything, or at least 3/4 of the gains. So there's opportunities in the future that we're certainly looking at, but you didn't see them in 2023. As far as our starting lineup, best of breed tech stocks that many of you see in your portfolio, enhanced income themes. I put VHT minus. We like health. We just don't like health insurers. And I used to work for some of them, so I definitely understand that market. Other ones, new in the Q1 of 24, we got into Texas small cap. We got into BITV, which just came into existence on January 14th. We got into our ego stocks. And what we've seen so far is the bigger ego stocks, the bigger market cap, Arista Networks, CrowdStrike, they've done better than the smaller ones, mainly because of interest rates. And then also things that we're going to get into in this second quarter, expanding out beyond just that best of breed tech, those top 4 to 7 positions, and just take a little broader, investment into tech. Not crazy low small cap, startups, but just to broaden that out. And that's why I called that mid cap expansion. So, and then as finally, as the interest rates become clear, we'll rotate out of some short-term bonds and some fixed treasury positions. Let's go to the next slide. Okay, Steve has talked about the 2 nevers, and in the last quarter, he spent some time on this. And this is what the Fed is battling against recession. So when we have a negative yield curve, the top graph, if this is the 10-year treasury minus the 2-year treasury, every time that curve drops below the red line, you can see there's a shaded spot coming up next, except for now. So this is every time there's been this inverted yield curve, we hit a recession. So far, we never avoid a recession with a negative yield curve. The bottom graph, this shows unemployment under 4%. We never have had a recession with unemployment below 4%. So you can kind of see the same thing. When the recession lines are in there, the unemployment's over 4. Right now we're at 3.9, so we're close. So as long as this continues, these 2 nevers battle each other. Next slide. Why is this important? The Fed is battling inflation, and one of the primary tools the Fed has is reducing or lowering the discount rate. And that graph in the middle is the discount rate. And what I want to show you on this is inflation is still out there somewhat. And there's 2 headlines I pulled from articles earlier this week. Inflation victory proving elusive. And then we see things like California raising minimum wages to $20 for fast food workers. That counteracts, keeping inflation low. So when you see strange things like that, where people just say, "Oh, we're going to raise the wages," and I won't get into the political side of should we, shouldn't we, that's happening. Um, these are things that affect inflation. Now, what's really fascinating to me, and it probably will affect some of you, is the graph on the right. If you concentrate on the red, that is auto insurance, and that is the percentage of inflation. So the latest inflation number they showed there was 4.1, and of that 4.1, you can see that auto insurance was 60% of that. Now, for those of us that have a young kid, I have a 17-year-old and I got her insurance. It's definitely higher than my other kids. It's went up. But I'll give you an example. Today I was talking to a business owner who has vehicles, and he told me, and I mentioned about auto insurance, and he said, "Oh, you're not going to believe this." He said, "For me to insure my fleet of automobiles or a fleet of vehicles for this business, last year it was 150,000. They raised it by 20%. That's $30,000. Now, so when I think of my own kid and it's 40 or 50 bucks a month, I don't like it, but it doesn't sound like a lot. But when you consider a small business, $30,000 more for auto insurance this year. Wow. These are parts of where inflation is still out there and the Fed's still dealing with this. I'll give you another side of it. We saw this in auto insurance because we're the consumer and we're the ones paying auto insurance. If you look at the health insurance world, the government pays a lot of the health insurance and they limited what they're going to pay. So what happened is the health insurers got caught in the middle. They couldn't raise the rates like they needed to, so they just eat the losses. And if you were invested in health insurance stocks this past week, you saw them drop 10 to 15%. Fortunately, that's not in our book, but that's just another example. Next slide. One thing, and I'll start off by saying, politically, you may be for or against immigration. We're not going to get into there. We're just going to say that immigration is occurring as we speak, both legal and illegal immigration. So we're not worried about, whether we're for or against it. We're just saying it's happening. And I want to show you a positive viewpoint from it. So the upper left graph is our labor force, and you can see that we've generally been adding jobs. If you look at 2021, 22, 23, you can see that we've added jobs. That blue column in there, those are foreign-born immigrants adding to our labor force. So if you've never seen this before, think about that. The last 3 years, more people have been added to our workforce that were foreign-born than native-born. And that may surprise you, maybe it doesn't. But what's happening is a lot of those foreign-born immigrants are actually coming in the lower side of the wages. So they're, taking jobs that, maybe our kids would be working, or maybe someone in their young 20s. And what that effect is it's keeping wage growth down. So this is a positive for us in the investing world. If wage growth was going up, if they were not filling these gaps, McDonald's would have to pay $20 an hour to get somebody to work there, or Taco Bell or whatever. We would have definitely more inflation, and the Fed's hands would be tied on lowering rates in the future. So that's a positive. In the lower left, you can see the blue line is our 18 to 64-year-olds percentage labor participation. So it's not that United States people are sitting at home waiting for jobs. They are participating. And then when you look at the total labor force, you can see the number goes down, because what's happening is every day 10,000 boomers are retiring. And every day, the best estimate I can find says about 5,000 people are immigrating into the United States. And this book that I have not read this book, but I found the cover and I thought it was interesting. Immigrants and Boomers, Forging a New Social Contract for the Future of America. This book came out in 2008, so it's been out for a while. So I'm not endorsing, certainly not endorsing illegal immigration. But I'm accepting the reality, and we should invest according to reality rather than necessarily what we want to happen. Next slide. So the big question, and if any of you follow CNBC or read the papers, we're always hearing, when's the Fed going to cut rates? Are they going to cut? We're hearing this discussion all the time. I mean, if I was Chairman Powell, I would probably get so sick of this question. And as you know, Ankerstar Wealth, the last time that we presented, Steve took a bold statement and said, hey, I don't think there's going to be any cuts in 2024. And he said that back in January 2nd, when I just started here. And at that time, they were projecting, I don't even know, 5, 6 rate cuts. They were projecting lots of cuts. Fortunately, Steve didn't trigger the whole market to sell off, because that's what happens when the market thinks they're not going to get rate cuts. But what we are seeing is the Fed starting to move to where Steve originally projected this. So he said no rate cuts. The Fed's down to 2 or 3. I've heard as early as June, but that's the chances of that happening are going less and less. So now we're hearing 2 or 3 towards the end of the year. And for any of you that are in business in considering the interest rates, the stock market loves this stuff. They absolutely want lower interest rates. The cheaper I can get my hands on cash, the quicker I can invest it and the more I can make. So what's happening, and probably the reason why the Magnificent Seven did so well and now continue to do pretty well, is there's smaller businesses struggle more with expensive cash, whereas an Apple or Amazon or Nvidia that have lots and lots of cash, while it's more expensive to use, they've got more of it. It definitely benefits the bigger companies. So what we're seeing here too with the Fed is they're projecting in the long run, go to the next slide, in the long run, they're projecting 2.6. Oh, go back one slide there. They're projecting 2.6 as the long run median, and that's starting to leak upward. It used to be everybody was around 2.5. And just to give you an idea, this dot plot, these are the committees of the FOMC putting what they think it'll be. So it's kind of like Chairman Powell's way of saying, hey, the 12 of you, give me your votes. Let me show me what you think, and we'll just kind of look at it all together. But what we can see is that longer run median rate starting to go up. And the repercussions of that is we always hear 2% in inflation, 2%, 2%, 2%. It's starting to sound like the Fed might be good with something like 2.5. I'm just saying that they're leaking that number up as an acceptable number. So just you'll hear that more in future presentations. Next. Okay, it's an election year. I didn't put this slide in here, but I did see a slide that says, whatever party you are in, if your person is president, you feel better about the economy. Now, and they show that year after year. So right now, if you are Democrat, you feel better about the economy. If you are Republican, you felt better 4 years ago. This is an election year. I will tell you, and I tell people all the time, presidents get too much credit and too much blame. This is the business cycle runs independent of presidents. But typically in election years, when people don't want to rock the boat as much, the market performs pretty well. And so far this year, it has performed well. And you can see that, through April, it's typically a little choppy, and then it starts going up. We had a fantastic first quarter. So I believe the choppiness is going to start happening, and we're probably already seeing it in the last couple of days, but expect that choppiness. In the first quarter, the biggest drop we had in the market was 2%. And that is not very high to have a 2%. So we certainly will expect more. Kind of on the good side, that I like this bottom graph, is the orange line is the 4th year of a new president. And whether, it feels like this isn't his first term, but this is his first term. So he is a new president, and the stock market does even better when it's a new president and not so much on a lame duck. So anyways, that's, just a little bit of optimism during this election. Just remember, as we go forward, as things become more clear, the market's likely to rally. Next. Another interesting thing happening, money on the sidelines. So this graph shows the overall money in money market accounts, $6 trillion in money market accounts. And you can see how much it's grown over the last 4 years. It's definitely went up. Two reasons why, or at least two that I'm going to cover. Baby boomers retiring. There is an appropriate allocation for their accounts in money market type funds like a USFR, in that kind of safe investment. That is appropriate because of that investing risk level. The other reason is higher than normal risk-free investing. So a USFR is paying 5.3%, which is a safe investment. It feels pretty good to get 5.3, like especially when in the past when you in a savings account got 0.2. So to see that, what will happen is when the Fed starts reducing those rates, things like USFR, the returns are going to go down. And same with the short-term bond funds. So what we're forecasting is to say, when those rates go down, that money's going to start shifting back for better returns, and it'll be a larger than normal boomerang effect. So it's good that it's sitting out there. When that money shifts back, for those of us that are heavily invested in the market, that'll pay off. Next. And this slide, although not extremely a lot of information here, this is very exciting. This is the quarterly earnings growth estimated for the Mag 7 versus the other 493 companies in the S&P 500. So the first quarter, you still see the Mag 7 that dominates that quarterly earnings growth, but you see these remaining 493 starting to catch up, starting to broaden it out. I mean, Nvidia and Amazon and Google, they can't keep growing faster than everyone else forever. Otherwise, they'll just take over the entire market. So what we want is this broadening of the S&P 500. So by fourth quarter, it's an expectation that those remaining 493 companies actually will have earnings higher than the 7 total. So that's good news, and that just we'll see that, especially with the market rates coming down at some point. Next. Okay, for our forecast, and you can see that a lot of detail here, but I'm just going to hit a few things. The Fed maintains stability, keeping rates 5 consecutive meetings in March. Don't expect that they're going to raise the rates, but I certainly don't expect they're going to lower the rates. And if they do, it's going to be right at the end of the year. But we're sticking with our original forecast that they will not reduce rates this year. And I'll just prepare everyone that, when the market starts to realize that, and I just sent it to Steve yesterday, I saw an analyst on the front page of the Wall Street Journal say, they may not raise rates this year. I just saw somebody say it. But when people start to expect that or accept that, we'll expect some, I call it market mini tantrums. So we'll see some of that. GDP continues to grow, although it's declining, but still growing. So that's good. Second quarter, expect that holding pattern. Don't expect big gains in the second quarter. In fact, I expect volatility as the market starts to accept there's not going to be a June rate cut. Slowdown anticipated for GDP. Likelihood of recession continues to decrease. And when you see that guy balancing there, that is a young Chairman Powell balancing, can I reduce rates? Will inflation pick up? And can I do the soft landing? This will be very impressive, and he's doing well so far. Overall forecast. So I did put down the market is expecting 3 rate cuts, but we do not expect it. GDP projections, we project it to stay 1.5 to 2.5. And just overall expect the CPI or the inflation to get down to about 2.6%. It was a little bit higher than originally forecast. but that's where we believe it will go. I'll put down the returns of 25% per year, unlikely. And as we talk to clients, and we typically say, 10 to 12 is realistic. If you looked at since the bottom of the COVID curve, the COVID drop in 2020, it has been over 20%. But that's unlikely to continue at that high. Next slide. This is the way we want it to be. So when it comes to surfing, we want our investments all to do well and us to all catch these big waves and just come in. But we have to realize that we're not going to catch every big wave. And the key is when things are going out, for example, an undertow on a certain stock or a certain ETF, there's sometimes we stay in it a little bit, but then there's other times we need to rotate out to make that decision. But ultimately, one of the reasons why you're here is just so that we can teach this level, we can invest this way, and we can manage your time this way. Go ahead, Steve. Next slide. I know that the next slide is Joel put out the forecast or his market update for the Q2. Excellent reading. I believe most of our views sync up around this, although we certainly can have differing opinions within the company. But definitely you want to read this. And now we can go to questions.
All right. Thanks, Mike, for everything. Fantastic presentation. Going to come back on camera here myself once I get this clicked over. There are no questions in the chat, even though I've been trying to inspire some there. Hopefully I'm on the camera now. So I'll throw out maybe, as we mature this, first of all, thanks to those that attended. And if you're catching us on a replay, again, questions, just hit them up wherever you received this, just put them there and we'll answer them. But as we try to mature this at the end, that's kind of when you get the hard hitting questions. So maybe I'll throw out a couple questions that you should ask. Again, Mike doesn't know these are coming, and I'll handle them. If Mike, you can throw them right back to me if you'd like. You mentioned the 493 stocks of the S&P 500 that we've projected. Now their earnings are going up. The Mag 7 earnings projected to go down. How do you plan to capitalize on that?
Okay. Well, first of all, I'll say that just because 493 overall is going up, I would not want to be in all 493 of those stocks. So we would never just be like, oh, we're going to put all our money in those 493 and count on that. They're, part of the reason, and you've seen some of our morning shows where we've covered automotive, we've covered airline stocks that are in there. And I'll tell you, health insurers wouldn't want to be in those markets. So right there, that would eliminate 15 stocks at least that I would not want to be in. So what we will do is selectively pick either ETFs that cover the ones we do want to be in, which might be, let's call it the next large tech after the Mag 7, or we will invest individually in some of those, different stocks. So anyways,
okay.
What do you think?
Sounds good.
Yeah.
I like that answer. So, part of investing is you get the thesis first, and the thesis is, okay, this is where we want to focus our investments. You don't often, the answers don't necessarily automatically appear, right? So we're going to have to talk this over and kind of figure out our exact game plan, but I like it, a combination of ETFs / picking some individual names in there. So, that is our strategy. As far as have another question came in through a direct message, thoughts on the Apple lawsuit. Mike's been talking a lot, so I'll take this one. So when you look at the world as it is, right? So there's Mike did a good job of, it's not endorsing things, but it's accepting that reality. Well, the reality is we have 7 companies or possibly 5, some of that's shaking out right now, but you have some just completely, thoroughbreds in the market. And there is a problem with size, right? So when you get too big, you can get monopolistic, and the Department of Justice is supposed to come down and keep that into check. They're the watchdog for you and I as the consumer. So Amazon can't just charge whatever they want, or Apple or Microsoft, that sort of thing. So you'll see lawsuits come up for monopolistic practices. And the Apple lawsuit was a specific question. Thanks for that. We call it the war on the green bubble, if you will. And it's kind of a joke, but it kind of isn't, right? Because you do know immediately if somebody has a non-Apple phone in your text thread because it shows up in a different color, which I think, as a consumer, I kind of think that's funny. But I can also see their point of, well, is that now somehow shaming them for not having an iPhone? And I would have to agree, right? So yes, I think it's a small lawsuit. I don't think it's really going to move the needle in the stock. The stock didn't care the day that it was announced. Less than a 1% move, that is. But I will say more along the lines of, okay, there are going to be lawsuits like this coming. Amazon, Microsoft, can they continue to grow and put up the numbers that they are without somehow being held in check? At some point, they're going to face either a lawsuit, or they're going to be denied any more acquisitions, or they're going to be forced to break up. If you go back to Ma Bell 80s, and the breaking up. So those are all good things. So these lawsuits are coming. Would be to kind of recap the answer to the question. They are coming, but I don't think they're really going to change what moves the needle on stock, and that's earnings per share. So if the earnings are rolling in, it's not going to change. And if you were part, my family was very blessed to be part of the Ma Bell breakup back in the day, where I think we had we ended up with 8 different stocks of different companies and benefited from that. So if they broke up Amazon, or there's always talks of breaking up Disney, and spinning off ESPN, and there's all kinds of things. Amazon Prime is a whole thing versus Amazon the delivery piece. So all these things I think would be a net benefit to those of us who are invested in those names. Okay, last question. The interest rate thing. So another question came in. Fixed income investors, it's time to start thinking about locking in long-term rates, 2-year or greater, for bonds. Perfect question that came in there, because I was going to say the last thing I wanted to at least talk about is interest rates. Mike, you want that one, or you want me to give my speech on it?
Go ahead.
Okay. Let's rewind Ankerstar Wealth 5 years. So we're at 0% interest rates, and folks come to me, and if I signed on a new client in their 70s or 80s, and we start talking about traditional portfolio management and the balance between equities and bond, fixed income in a portfolio, fixed income wasn't making any money. It just wasn't. There were no CDs to be had that weren't laughably low. So 0%, or they offer you 0.5%. It's like, oh, it's not worth not worth even doing, right? So that was a problem. They called it the Tina market if there is no alternative to the stocks. And when Mike was talking about, if we do get these Fed rate cuts down the road, it's going to be a tailwind for the market, because it forces all that money out that's sitting in 5% CDs and 5% treasuries. It's got no other alternative, so it has to go into stocks or just sit in cash. And most people are sophisticated enough not to sit in cash. So I'm sure you could argue that point, but for a fully invested investor, that would be the point. It would have to shift somewhere else. So right now we're at the, CDs are still paying 5%. When I talk to folks on a daily basis and they're like, I have money on the bank, what can I get for it? And I'm like, you can still get 5%. USFR is paying 5.3%, which again is a package of floating rate treasuries that are short term. So not to get into too much of bond math, but CDs lock in anywhere from, you can have short-term 3 to 6 month stuff. We try to go out to a year to 18 months is kind of the sweet spot to get the highest rate. If you were to go out 2 years, you probably can't get 5% anymore. And that's the interest rate chart. And if you go out past that, there's no way you're going to lock in 5%. They're going to give you 4% and some. So there's a sweet spot. Is the root of this question that came in is, what do we need to be doing now? Well, there's 2 options. Is if you can't renew a CD at 5%, we're probably not going to renew it. If USFR, which is a little more liquid and it accrues every day and it pays out once a month, it's really just like a high yield savings holding. If it's still paying above 5%, well, if we can't lock in a CD for 18 months, we'll just put it in USFR. That's for our risk-free stuff. But as you look at your bond ladders and things, you can take the opportunity now, because companies that need to raise money now have to pay up for it. and they, if they could wait, they would wait. If they can't wait, they're going to end up selling a bond to you at an investment grade north of 5%. So it's called duration, is how long you can lock it in. So yes, we are looking for opportunities to lock in past 2 years, that kind of 2 to 5 year sweet spot where you can't get quite 5 maybe, but you might be able to lock in a 4.9 for 5 years. So that's what we're looking to do for your portfolios. If you do happen to have CDs that are maturing, you can watch alongside and see what we do based on the information that day. But that's the overall strategy. And then the second little derivative of that question is, do we use individual bonds or bond funds? And it depends. I like individual bonds. They're time consuming and a little bit tricky to buy. But if I have you in a bond ladder, expect the bond ladder to continue. If you're not in a bond ladder, expect that we'll be adding into a bond fund. Some names, VCLT, LT being long-term, that's a Vanguard fund that we use, that many of you are in already, and JCPB is another investment grade bond fund that we use. But either way, to summarize, is we're going to take the free money while we can get it. When it starts to fade, we're going to throw the net out as far as we can hold on to getting some decent returns close to that 5% as we can get. And then eventually when that stuff matures, it's going to be right on back into equities. So great question.
See another question on NEO.
Okay. I'm familiar with that. You want me to take that, Mike, or?
Well, I'll start off by just talking about China first, because I didn't spend much time talking about tariffs. But if you remember the previous election, there was a lot of talk about tariffs. Like, let's be hard on China, and not investing NEO directly there. And Steve can speak to that. Overall, I would be a little nervous with the Chinese stocks going into this time with the elections. Steve, go ahead.
I was gonna throw the NEO chart up while you were talking. Once I can get into the right screen here, but
so we've got EVs in China combined, with less expensive gas. I don't know.
Yeah. So technology is not working, cooperating with me, or I'll catch up in a second. So I'll talk to NEO. So yeah, so NEO rode high for a long time. It was a fantastic name to be in. Was considered one of the leaders of the Chinese tech movement. Li Automotive was another one. There's several other names that are out there. And the issue with it, the thing is, I want to say it's down below $5, maybe closer to $4. For some reason, Google Chrome is not my friend right now. There it comes. So yeah, so Luckin was a play. This was the question was asked by a board member / long-term investor, first investor actually of Ankerstar Wealth, and Luckin Coffee was he had said, is NEO another Luckin Coffee? And the question there, I'm getting an unresponsive, so no. It's not going to happen. So Luckin was a stock that we rode higher. It was the Starbucks of China for a long, long time. And then it really, it peaked out. Then it ran into some accounting issues and then it kind of crashed back down. And then it started back up again. So a lot of times you can take a ride on a stock like that, but it's not really a pure investment. It's more of a trade. Those don't present themselves all that often. So that's kind of the answer to that question. So I would show you a graph, but my computer's not cooperating.
It's trading at a 52-week low right now, 449 close. It looks very standard to it. Spiked up in 2021 up to $60 a share and has rode it down. I wouldn't, at a glance, it would be dangerous. Not like Luckin. Plus, there's I guess the theme with Luckin is all across China with coffee. There's plenty of competitors, unfortunately, in the EV space.
Yeah, and even in the EV space here in the U.S., Tesla, which I've been against Tesla for a long time because it was valued as a tech company, not a car company. Now that that's coming back down, I think Tesla continues on down. So the EV space, I think they are eventually just going to become cars, like everything else, and not be valued as these like miracle tech firms. Okay. Any other questions are out there? Good questions. I appreciate it. Okay, with that, I think we are going to wrap. Mike, I thought you did an amazing job. Thank you. Thanks again for everybody that attended. And if you're listening in at home on replay, again, reach out through whatever media you consume this. Put a note in the chat if you have questions. We'd love to start up a conversation with you. And with that, I'll let you guys go and you have a good evening.